Last thing we need to cover before we're ready for the next exam are debts and deficits. So what are debts and deficits? They're often confused for the two, and the two terms, debt and deficit, are used interchangeably, but they don't mean the same thing. So to start off our discussion of what they are and how they work, we're going to start with some definitions. First thing you see on the screen here is the definition of a budget surplus. This is, like any endangered species out there, something that is very rare, and you usually have to go to an economic zoo to be able to find one, but they have happened. They do exist. It is the situation, as you can see from the definition here, in which government receives more revenue than it spends in a given year. So the government taxes people and gets revenue in that way, and then spends money to, we'd like to think, just build bridges and roads, but they also pay bureaucrats to shuffle papers. And the difference between the two, if the government comes up with a positive amount because more revenue came in than was spent, we have a budget surplus. Since 1970, we have had, I think about 3 budget surpluses. So they don't happen very often at all. Deficits are the norm. So, deficit is, this is not an endangered species. This is like a cockroach. It's always there. It'll always be there. If a nuclear attack happens and the world gets vaporized, cockroaches will still be there, and so will budget deficits. You pretty much never see anything but a budget deficit, and this is the opposite of a surplus. You're bringing in some tax revenue, but you're spending a heck of a lot more than that. So pretty straightforward. Balanced budget is when, of course, you bring in exactly as much revenue as you spend. So it's all pretty straightforward so far. Balanced budgets are oftentimes referred to, surpluses are oftentimes referred to as balanced budgets. The budgets are in balance. Maybe a more simple way of saying it. We'll get back to balanced budgets in the form of balanced budgets amendments later, but what is the difference between deficit and debt? So far we have a very straightforward, understandable definition of deficits. Government brings in less revenue than it's spending. Well, debt is exactly that for every year. Kind of the simple economist definition of the national debt is the accumulation of all previous budget deficits and surpluses ever. This is maybe a little overly simplistic because a lot of former deficits involve borrowing that was completely paid off, but it's a simple way of thinking about it that distinguishes between the two, which is why most economics textbooks are going to have this definition, and this is the definition I'm going to use in my exams because it's the one you need to be the most familiar with when it comes to academic economics classes. So the deficit, once again, is the government brought in revenue and then spent that revenue on whatever the government decided to spend on. And then the government still had more spending to do, which sometimes might be because of legal obligations like Social Security. Whether you have the revenue or not, the government has to send those checks out. So going into debt is the way that the government does this, just like if you have to buy a home or you're better off buying a home, you usually don't have the money lying around, so you go and borrow money. It's not necessarily a bad thing, even though debt is usually a dirty word. A lot of businesses borrow money to continue operating, even if they're not bringing in enough revenue, and these aren't necessarily unhealthy businesses. It's sometimes just the best way of doing things, but it can also be a little problematic. But for the most part, you need to know the distinction between debts and deficits. Debt is the money that is owed for all the borrowing that was done in the past. That's another good functional way of understanding them. So how does a nation borrow? We hear about the debt all the time. We hear that our government has had to borrow to pay for this, that, and the other thing as people argue about politics. And it does sound like the government goes to some I don't know, super bank somewhere or something and fills out a bunch of loan application paperwork and has the super bank check, gets FICO score to see what its credit is, and then they're either approved for a loan and they're not. It has happened. The government has gone to borrow money from private individuals in that manner, but that's not generally how it's done. How it's done is the government essentially sells bonds. And this isn't just the government. This is businesses too. You hear about corporate bonds, the bond market in general. It's Bonds are essentially sold. They're financial assets. Here, I'll sell you a financial asset. Maybe you can try that if you're ever going to borrow money from somebody. Here, let me sell you a financial asset. Give me some cash now, and then later on, I'll give it back with interest. That's what a bond is. Somebody gives you money if you're issuing the bond, or if you buy a bond from somebody else, if you buy a bond from the government, T-bills, treasury bills, that's the typical government bond, and we're going to be talking about that a lot when we get into money and banking. Banks hold a lot of these, and fiscal policy centers around bonds for the most part. We hear these terms a lot, but we often don't think about what they are. A bond is really little more than a contract that you receive once you give your money to whoever issued the bond. Or if you bought a bond from somebody else, then somebody else already had that bond. They already lent the money, and now they gave the right to receive payments on that loan to you. When you buy bonds, you have basically bought access to the repayment of the original loan that was given. And if it's $1,000 bond, you basically lent $1,000. And you're going to get that $1,000 back plus extra money, plus interest, whatever the interest is. Sometimes the interest is paid at intervals. A lot of bonds, you don't get any money until the bond comes to maturity, which some of them do in as short as 3 months. Some of them take 30 full years before they come to maturity, at which point you get every penny of the principal back plus interest. So the way the nation borrows is it issues these bonds to all sorts of different people. And we're going to cover who those people are. They're people and organizations of people. The government is essentially selling an opportunity to make more money, to take the money you have now and make it a little bit larger without having to do anything. It's essentially an investment. If you're lending to the government or to anyone who issues a bond, you're essentially investing in them in a sense. You're not taking partial ownership of the enterprise like you would if you buy a company's stock, but it is an investment in that you're turning a certain amount of money into a larger amount of money. Inflation is important here, though we already talked about that. But assuming that inflation isn't going to be higher than your interest rate, you are still going to make more money than you had in the beginning. And why on earth would people lend money to the government? Well, if you lend money to somebody, you want them to pay it back. And governments tend to be among the best people or organizations to lend to because they're going to pay it back. Some governments have defaulted, but even those governments that have defaulted, the most recent kind of famous or infamous example was Greece about almost 10 years ago now, but even they ended up paying everybody back to whom they owed money. They just didn't do it when they were legally obligated to do it. But they still did it ultimately. So everyone still got their money back. And the United States government has never, ever defaulted on any of its debt. Some people think the U.S. government came close recently, but that's actually not entirely true. But that's a different video, which I will get into a couple videos down the line here. So you give your money to the government in the form of a bond. You can bet that you're going to get it back precisely when it's owed. And the government, of course, it gets to continue financing whatever it needs to finance, building bridges and roads and paying teachers and our military personnel and everything else the government needs to do, even if tax revenues aren't up to the task. So it is essentially an everybody wins scenario as long as the government doesn't end up in a debt crisis, which again we'll talk about. But first we need to distinguish between internally held debt and externally held debt. These are things you're expected to know, but there's also an important thing I'm going to get to at the end of this video sequence about externally held debt and if it's potentially a problem. But, well, the differences are pretty straightforward. Internally held debt is debt that is owned by U.S. citizens. When you hear that we owe most of our debt to itself, it's because over 2/3 of the United States debt is debt owed to United States citizens or organizations. Mutual funds own a lot of the debt. Remember, those are businesses that take their investors' money and invest it for them, so their investors don't have to worry about doing the hard work of finding somebody to sell a stock or whatever, and mutual funds will manage these things and give people the payments they're owed over time. Bonds are a big thing that will be included in a lot of mutual funds. So bonds are some of those organizations government owes money to. So when government pays the debt back, most of it is being paid to United States citizens. Our children's children will have to be on the hook to pay off our debt. Well, for 30-year bonds, our children's children will also be receiving those payments. Something to keep in mind when thinking about how big of a problem this is or whether it's a problem. Now, there is externally held debt, which is the opposite of internally held debt. This is when someone in Canada buys a US T-bill, or the government of England has a certain amount of T-bills among its assets. We're going to talk about China because that question comes up a lot, but a lot of Chinese government institutions and businesses have a lot of United States treasuries among their assets. This is externally held debt because when the debt is paid off, that represents money that leaves the United States and goes somewhere else. Debt servicing is another bit of definition we need to know, but this really isn't anything very complicated either, like a lot of the other definitions. It's just a fancy way of saying how much it costs to pay back the debt. You owe a certain amount of principal on the bonds you've given out, and you owe interest. When those are due on a particular date, you pay them. The amount of money you paid is the cost of debt servicing. So in the United States budget, you can look it up. It's free information. You can see the amount that the government spent paying back bonds that came to maturity. And that is the debt servicing cost. If there is ever a debt crisis, is what it's often called, it usually means that the government has to pay back so much debt that it has to start cutting back on other services, or it has to go into even more debt, which might not even be possible. So this is this really is the main concern of a government getting into too much debt, is whether it can pay it all back or not. We're going to get into we'll get into crowding out in the next video. Just chew over the other things I talked about before, and then we'll talk about some of the other problems like crowding out